Primary Gold has announced a scoping study for their Mt Bundy gold project, which is located approximately 110 kilometres southeast of Darwin in the Northern Territory. Overall, the results of the study confirm the significant potential for the Mt Bundy project to be a large tonnage, low-cost operation. The study has resulted in an updated valuation for Primary of 35 cents per share. The two key highlights of the study were the low capital and operating costs. First, the capital costs were lower than what we originally anticipated. Other development projects of this scale typically have total capital development costs in excess of $200 million. However, due predominantly to the project's location near an Australian capital city, there is already significant existing infrastructure in place. This includes water, power and telecommunications, a national highway within a few kilometres of the Tom's Gully deposit, and most importantly, a skilled workforce within driving distance to the project, meaning Mt Bundy will be a drive-in, drive-out operation. The second major highlight was the relatively low operating costs of just $1,050 per ounce over the life of the asset. This was driven by the exceptionally low strip ratio of 1.8. The cost decreased further to around $900 per ounce during the first 3 years of production, when the high-grade Tom's Gully deposit is also mined. Whilst this scoping study has provided a strong platform for the Mt Bundy project, we have identified a number of areas that we believe could be targeted for improvement in future studies. Central to these potential improvements will be further exploration drilling at Mt Bundy, with the first program due to commence in the coming months. This will be the first significant exploration program at Mt Bundy for more than 20 years. The initial program is focused on testing brownfield extensions to the Rustlers Roost and Quest 29 deposits, with a clear target for increasing the confidence level and size of the existing resources. There will also be drilling at a number of high-priority greenfield targets within close proximity to the proposed facility. And whilst not a part of the initial program, we expect drilling at Tom's Gully later this year, with likely targets to include a number of historical high-grade intercepts which sit outside of the resource area. Assuming this program is successful and the resource, therefore mine life, increases, it is likely the current throughput of 3 million tonnes per annum will also increase. We have highlighted in the graph below the potential increase to the production profile, assuming a 5 million tonne per annum facility was used. All things being equal, this would also likely decrease operating costs per ounce of gold produced. Other factors that we believe will be targeted for improvement include the head grade mined at Rustlers Roost, further potential reduction in both capital and operating costs, as well as improvements in gold recoveries through the use of different processing technologies such as resins. The graph highlights the potential effect on our valuation if the mentioned improvements through this analysis occurred. We look forward to the commencement of drilling at Mt Bundy in May, as well as the PFS for the Coolgardie project later this year.